What if I could show you an easy way to add $1 million to your estate? We recently had a client with a corporate investment account, and through some strategic planning, we were able to add over $1 million to their estate with one simple change. I'm going to jump into the software here and actually show it to you and the impact that it has and how easy it is to do. But again, when you have a corporation, a lot of the conversation is like, how do I draw that down? How do I actually use the money that I've worked hard to build up in my company to live in retirement? Now, for some of you, you're lucky enough that you've built up enough personal assets that maybe those corporate assets don't even need to be used. But then what happens with it? How does it pass on? How do I make sure I don't pay all this tax on it when it does come out when I die? So that's what I want to jump into and go through in this scenario. So here we have John and Andrea at YouTube, and they've built up personal assets. They have about $500,000 in a non-registered account, combined about $230,000, $240,000 in a TFSA, and $1.3 million in an RSP account. Now, their concern is like, how do we draw down our income? They were asking for $120,000 after tax and adjusted to inflation through the go-go phase of retirement. Now, they also had a corporation that I'll show you here. So again, in our planning software, Snap Projections, we add in the corporation. Everyone's corporation is a little bit different. For John and Andrea, they had money in it. So they had the asset sitting in it, but they were no longer operating. So it was a company that they operated for many years, and they had about $875,000 invested with a cost base of $750,000. So as we went through the planning, we looked at different options of drawing down their corporation, doing just personal contributions, looking at many different factors. Now, when it came down to it, and we looked at drawing out of their corporate account first, delaying on their RSP, because they had a decent size RSP account, we felt and it made sense from a tax perspective to start drawing that down. So what we did is we created a bunch of scenarios, and one of the scenarios that we created that worked out the best was, let's actually not touch your corporation. We'll just leave that aside for the next generation, but we'll use your personal assets that you've built up to draw down. So your RIF account, your TFSA, and your non-registered account. So we built tax efficiency around that, and they had enough assets there to meet their income needs. So the $120,000 in the go-go phase, then 90, then 72,000. And we can see that by age 95, when Andrea turns 95, there's still $2.2 million sitting in the TFSA account. So even in this plan where we weren't even touching their corporation, they were able to draw down enough money out of their personal assets to meet their income needs. And in fact, 120 was on the very high end, 90 was on the high end, and 72. So they were very comfortable with, look, even if we need to spend a little bit more, this is already on the high end, but there's still extra money there that we can draw on. And again, it's sitting in the tax-free savings account, so it's very tax efficient that way. Now, while this plan worked really well on the personal side, the issue with the corporation side is that company was just sitting there. We're going to have that money invested and working for them and all that. And they would draw out their capital dividends, which are tax-free dividends that they can earn over time based on capital gains on their investment. So we have that all mapped out on here on the capital dividend side. But at the end of the day, the account value goes from under 900,000. And if we scroll all the way down to age 95, you can see there's over $2 million sitting in that account. We can look at, on death, what's going to happen. Well, there's a fair amount of money there. There's some tax to be paid. And there's a lot of non-eligible and somewhat eligible dividends coming out of the account. A lot of it's taxable. It's not a very good tax efficient plan to have in place with regards to the corporation. And so for those of you that are watching this video that say, Adam, this is me. I have a corporation, I have some personal assets. I don't know how to kind of draw stuff down. Look, step one is to work with a financial planner that understands how to do this. And you want to look at a few different scenarios. What happens if I draw down my corporation first, then my personal assets? What about my personal assets and corporation? What about combining the two and looking like what's the integration between them? Everyone's situation is different, and I know you probably get tired of me saying that, but that's the reality. And again, for John and Andrea, their situation was burn down the personal assets, leave the corporation, and let's figure out a better solution with that, which I'll cover off here in a minute. But for you, if you're sitting there with a corporation, there could be 100,000 in there, $1 million, $10 million. It doesn't matter the number. You need to figure out, am I going to use that corporate cash through retirement? Does it make sense? And if I'm not, then what do I do with it? What's the best situation? How do I make sure that passes on to whoever or wherever I want it to pass on to in the most tax efficient way? So for John and Andrea, we talked about, look, you're never touching your corporation, and when it passes on, there's going to be a lot of tax due. It's not a great estate planning situation to have, but we could look at using that money in there. One of the issues is we're paying tax on it every year at highest tax rate. Again, corporate investments are taxed at the highest marginal tax rate in Canada. So that's not an ideal situation. Plus, when it passes on later on, again, more tax to be paid. So what we want to do is we want to kind of shelter some of that asset along the way and then make sure it passes out as tax efficiently as possible. Now, one strategy we employ for our clients is what I like to call a corporate tax-free savings account. Now, what is a corporate tax-free savings account? It's essentially a whole life insurance policy where you can shelter a lot of your investment and investment growth within the corporation. So think about a personal TFSA account. You put money in there and it grows tax-free. When you pull money out, it's still tax-free. It grows tax-free, it's pulled out tax-free. With a whole life policy within the corporation, you can put money into there, it grows tax-free, and when it pays out death benefit, it comes out tax-free or very, very close to that. So it works essentially like a tax-free savings account, hence why I like to call it a corporate tax-free savings account. Now again, this isn't a solution for everyone, but if you do have a corporation, you need to at least go through this process with your financial planner to see if it's the right fit for you. So looking at John and Andrea, again, we're doing the 120, 90, 72. We haven't changed anything on the personal side. We're still drawing down that the RIF account, topping up the TFSA as much as we can, slowly using the non-registered account. Nothing's changed here. Where things have changed is in the corporation, and I want to break this down for you. So you can see here their financial assets, and we have this additional column called insurance. Now again, how much insurance is all going to depend on how much cash flow, how much insurance you need, all of it. Now one thing to keep in mind, to build this corporate TFSA, you need to be insurable. At the end of the day, John and Andrea are buying life insurance. When you buy life insurance, you have to be healthy enough to get life insurance. So that's a big factor. So if you're looking and saying, hey, this is great, this is for me, but your health is really bad, this may not be an option for you, or it's going to be very expensive where it probably doesn't make sense anymore. So again, a corporate TFSA account really only works if you're insurable, if you're healthy, if you can still get life insurance for a reasonable rate. Again, talk to your financial advisor to figure out if this could be a solution for you. So in this case, I ran a whole life policy with Manulife. I personally have a policy like this myself in my company. And you can see here the death benefit starts at about $557,000. The CSV is a cash surrender value, meaning if they surrendered the policy, if they stopped paying into it and just said, look, I'm cashing this out, there is a value there. And the premium is the annual premium that's due every single year. I won't get too much into the insurance here. Again, that's kind of the solution to the overall solution. We need the insurance to help us with the tax planning. Now, what we can see in this scenario, I've had the premium due every single year until age 95. That could be offset after 10 years, after 20 years, somewhere in between. It's not a premium you have to pay for life. Again, every situation is different. Figure out what the best solution is for you. You can see that cash surrender value, if they cancel the policy, that continues to grow year over year, as does the death benefit. So again, this was money that they weren't touching in their corporation. You can see over time, even though the account starts at over $800,000, it does dip down slightly. Goes all the way down to about $0 at the end. Now, again, I would typically look to stop paying this policy later, but this does essentially work very close to the end. It's a great way to structure the policy and shelters a lot of that asset along the way. But let's look at what the net benefit is to doing this. So again, a situation where a client had more than enough money, they were never going to run out of money. It was more, how do we make sure we pass on as much as we can? Let's make sure our money goes to our children, our loved one, charity, versus to CRA on tax. So in this case scenario, we looked at it and said, look, again, we're not touching the corporation. We looked at putting the insurance in place and it made a massive difference. And let's look at that difference from a number perspective. So you can see here their lifetime expenses, meaning their total income that they've drawn is the same. Their retirement spending is the same. We haven't changed any of that. Their lifetime corporate tax. You can see their corporate tax goes down $625,000. And that's because we're putting money into the insurance policy and growing that money tax-free. Again, a corporate TFSA account. If we put money into a tax-free savings on the personal side versus sitting in a non-registered account, we're going to pay less tax. So that makes sense. So we're saving $625,000 in their lifetime on taxes. So again, income's the same personally, all of that. What I want to look at is the estate. We can see here that the real assets are roughly the same. Total assets are a little bit less on the personal side, but because we have that corporation and it's worth a lot more, that's where the difference is. So again, the estate before tax, you have about $757,000 more with the insurance than no insurance, so the corporate TFSA account. And then tax is much less because we've sheltered that money and we put it into an insurance policy. When the insurance policy pays out, it pays out essentially tax-free. Depending on when you die and how you structure it, it's going to be fully tax-free or very close to being tax-free. So you can see the tax bill goes from 1.16 million down to under $400,000, $765,000 less tax at death. Meaning the client has $1.5 million more in their estate because of the insurance policy. So a massive difference. So for this client, it was all about how do we make sure that that corporation is structured in a way where we can pass the most amount possible to their loved ones and not CRA. So doing the corporate TFSA account through an insurance policy allowed them to do that. Again, we looked at different numbers. We could do a bit less, a bit more. Everyone's structure is a little bit different, but the strategy can work. And when it works really well. And we tell clients this all the time. This strategy isn't for the masses. It's for a small group of people that have built up a good corporate account for their investments and are never going to need it. And when these strategies make sense, they make a lot of sense. Like typically, it's millions to tens of millions of dollars of additional savings. Money going to your loved ones, to a charity, to whoever you want it to go to versus CRA. And I think that's all what we're trying to accomplish. So again, if you're sitting there with a corporation, not sure how to structure it, talk to your financial planner or reach out to our office. We're happy to help you map something out like this. See if this is an option for you. You can learn more at parallelwealth.com/planning to learn more about our fee-for-service financial planning services.